So welcome back. Now in the previous lesson, we have very well understood what are Fibonacci ratios and what is Fibonacci retracement in context of the stock market. And then we left with certain questions in our mind as to what time frame should we consider, how would we know whether it is a retracement or a trend change, and how would we know where the retracement would stop, and then what happens if we take a trade position and the retracement does not stop. So we shall try and find answers to all these questions in this lesson. The first question, what time frame should you consider? I would like to tell you that first of all you have to be very clear in your mind as to what you are looking at. If you are looking at a monthly chart, then don't expect the retracement to happen in a day or a couple of days. Similarly, if you are looking at a daily chart, then you should not wait for retracement to happen for a week or a month. You have to decide what you are looking at and what you are expecting. In my opinion, Fibonacci retracement works best for intraday trades. That means you take a trade position somewhere early during the day, and before the day ends, you have to close your position. Sometime you may also keep it for a couple of days. But that does not mean that you will get a retracement opportunity every day. Sometime for days together you may find that there is no retracement opportunity. The market opens at a particular level and then continues in one direction. It will not give you a retracement opportunity at all. And then, I personally prefer day trading with Fibonacci retracement. But different people may have different view. Some people may take intraday view, some may take view for a few days or a few weeks. Some may even take a view for a month or maybe a couple of months. Nothing wrong in that. But personally, I feel that Fibonacci retracement is not suitable for longer periods. Why is it not suitable? Because in the longer period, the external factors may disturb the Fibonacci pattern. When we talk of Fibonacci, it is something to do with natural occurrence, something which happens on its own. But if there are external factors which are influencing the market, then the Fibonacci pattern may get disturbed and may not give you correct results. What could be the external factors? See, over a period of days, if you have a long-term view, then what happens is some positive or negative news may come in the market, and that news may disturb the market in either direction. That news could be anything about the economy or about some company or whatever. Or some company may declare, a big company declares a result and the results are not good, or the sales figure are not good. Not only that company suffers, but the whole market gets disturbed. So the Fibonacci pattern also gets disturbed. Then release of the inflation data. Very frequently inflation data is released, and inflation plays a very important role in the stock market. You get, worse than expected inflation result and the market will topple. Or some other economic data like the unemployment figures or maybe some IIP figures or whatever. And then the Fed policy. Fed policy announcement is there very often at periodic intervals, and if the Fed decides to increase or decrease the interest rates or the policy rates, that may disturb the market. The global economic data may disturb the market. The dollar index, the bond price changes, all these things will affect the market. Volatility of the crude price. You get up tomorrow morning and you find that the crude oil price has either risen by 5% or fallen by 5%, and the whole market gets disturbed. So the Fibonacci pattern will also get disturbed. Political instability. The government statement, some policy decision the government takes, some statement comes from a politician or the president, and then you find that the market is all shaken up. War tension between two countries. Suddenly one country throws a missile on another country and the market direction changes. So in such scenario, over a period, the Fibonacci pattern will not work. But during the day, during the intraday trade, all these factors have very minimal effect. Therefore, Fibonacci works better in intraday trade. I would also like to tell you two things. One is that whatever stock or the index which you are considering, that must be either in a strong uptrend or a strong downtrend. A trend has to be there. If the market is range bound, then there can be no retracement. For the retracement to happen, there has to be a trend, isn't it? Without a trend, how will a retracement happen? And then there are different ways of determining the Fibonacci levels. Some people use paid software. Several paid software are available in the market, which will show you just by a drag of the mouse, they will show you various Fibonacci levels. Personally, I don't recommend, but still there are people who use paid software. Some traders follow the ready-made Fibonacci figures or the levels which are given on the trading platform. Whichever trading platform you are using, that platform will display some Fibonacci figures for the stocks as well as for the index. And then some traders prefer to work out manually the levels. Like I have explained to you in the previous lessons, how we work out the three support levels and the three resistance levels manually. I personally would recommend that you should work out your levels manually. I don't believe in this paid software or the ready-made levels. But just to give you some examples or show you how it is, this is the screenshot of a paid software. You just drag your mouse from one point to another and it will show you various bands. The various Fibonacci levels it will show you. The period what they have considered is from this point to this point, and it is clearly a downtrend here. Alright. Fibonacci levels are generated automatically by the software. On this left hand side you see the Fibonacci levels. I have encircled the important ones, 23.6, 38.2 and 61.8. Those are the golden levels which I consider. All this other information may not be relevant to us. Alright. And on the right hand side, corresponding to this Fibonacci levels, you find the price. So accordingly you can take a trade if you are using a paid software. If you are using a trading platform, like this is my trading platform, ICICI Direct. If I open this for Nifty, here I am looking at Nifty, and at the time when I am recording this, the Nifty has made a high of 17,715 and a low of 17,557 during this period of the day when I am recording this. And the current price of Nifty is 17,650. Alright. So if I plot it on a graph like this is the low point of the day, this is the high point, and at the moment the retracement is happening actually. You see here, actually the retracement is happening. See here, this is the low point of the day, 17,557. This is the high point, and this is the current price. That means the retracement is happening. Alright. And if I click here on the Fibonacci values, if I click here like this, then I get the Fibonacci values. They are displayed here on the screen. 6 Fibonacci values they have displayed. All of them may not be of use to me. Let me also show you how we manually calculate. I have already showed you in the previous lesson, showing it to you once again. Alright. So this is the low level, this is the high level, okay, during the period of my observation. And if I subtract the lower figure from the higher figure, 158 points. So during this period it has gone up by 158 points. How much will it retract? We have seen the three golden levels. Okay, if it retraces by 23.6%, then it would be $37.2 or rupees, whatever, don't consider the currency. And if it is retracing by 38.2%, then it would be 60.4. If it is by 61.8, then it is 97.6. Alright, so let us see now. My first support level on the downward journey, my first support level comes at 17,715 minus this 37.2. So that gives me 17,677.8. That level has already crossed here. The level would have been here. The price has already come below that. That is why it is not being seen here in these figures. Okay. So the first support level has already crossed. The price is further moving down. Where is my second support level? My second support level is at 17,715 minus this 60. Okay, it gives me 17,654.6. And the website is showing me 17,655.27. Minor difference. doesn't matter. Okay, so this level is yet to come, 17654, or rather this we are almost at that level, little crossed that also. Okay, and it has not gone started going up. It may probably go up from here. The third level is 17715 minus 97.6. It is 17617. Here also it is 17617.78. I have got it 17617.4. Not much of a difference. Okay. So probably once it comes here, 17617 will be somewhere here. After coming here, probably it will start rising up. If it does not start rising up here also, just too bad. That means the trend has changed. We don't know what will happen. We'll not wait to see that. We'll proceed. Okay. Another point here. All these other figures are not relevant to me. You see the internet or the website, or for that matter any particular website you see, it will be an ocean of information. We don't want to have all the fish which are there in the ocean. I will select only the data which is useful to me. All this data is not useful to me. I don't bother about that. Got the point? Now we come to the second question. How would you know that the retracement, that it is a retracement and not a trend change? Okay, how do you know that it is only a retracement? The direction has not changed. You see, if it is a very strong uptrend, then the probability of retracement is higher. It is less likely that if the trend is very strong, the direction will change suddenly. Direction will not change suddenly. First, it will become neutral, may take a couple of days. So, if the trend is very strong, then you can safely assume that it is a retracement. Secondly, now if you are looking at the uptrend, at the peak here, from where it has started coming down, you have to see whether there is any bearish reversal pattern of the candlesticks here. If there is any bearish reversal pattern, then probably it is a downtrend. Otherwise, you can safely assume that it is a retracement. Okay. Secondly, you have to also see the volumes. As the price is coming down, you have to see what are the volumes. If the volumes are very heavy, if the volumes are more than 2 times or 3 times of the average daily volume, then you may fear that it is a direction change. But if the volumes are less than the average, then you can safely assume that it is not a direction change, it is just a retracement. If you want further confirmation, then probably you may have to wait till it comes to the first level of retrenchment or retracement. Okay. Similar would be the case in the downtrend. We saw for the uptrend. Now in the downtrend, it will be a similar thing. If the downtrend is very strong, then it is very unlikely that the direction will suddenly change. It will probably be a retracement. Okay. And again, at this point, you have to see whether there is any bullish reversal pattern. This price moving up, is there any bullish reversal pattern here? If there is one, then you may fear that it is a change in the trend. But if there is no reversal pattern here, then it is just a casual thing. You can safely assume that it is a retracement. And again, when this price is going up here, in the previous case it was coming down, here it is going up. So as the price is going up, you have to see whether it is accompanied by high volumes more than 2 or 3 times the daily average volume. If that be the case, then it may be a direction change. But if the volumes are not much, if the volumes are less than the daily average, then you can safely assume that it is a retracement. Got it? And if you want more confirmation, of course, you wait till the first point here, till it comes to 23.6% retracement, you will get a better confirmation there. Alright. Now we come to the third question. How would you know whether the retracement will stop here, 23, 38 or 61? Where will it stop? You can never know that for sure. You can never tell that. But you can make an analysis. Again, how you make an analysis? See, if the uptrend is very strong or the downtrend is very strong, very strong, and at the time of retracement here, this retracement in both the cases, if the retracement volumes are low, then you can expect that the retracement will stop at the first level itself. Here or here, it will stop at the first level. But if the trend is not very strong, It is just strong enough, not very strong. And the volumes at retracement, volumes here, they are average. They are not very low. If they are just average or little more, then you may expect that the retracement may stop at the second level here at 38.2 or here. Okay. But if the trend is not strong enough, if the uptrend is not very strong, or if it is a downtrend, it is not very strong, and the volumes at retracement are also quite high, in that case, the retracement may continue till 61.8, or maybe it may continue even beyond this, and the trend itself may change. If this is the condition, if the initial trend is not very strong, and if the volumes at retracement are high, then you will have to be very, very cautious. All right. Now we come to the fourth and the most important question. What happens if you take a trade position thinking that the retracement has ended, but the retracement continues? Say, for example, at the first support level, you think that the retracement has ended here and you take a position, buy position. But the retracement continues, it keeps going down. Then what happens? You will be at a heavy loss. You see, everybody thinks or everybody wants that they should be able to sell out here where it is the peak, and they should buy here where it is the bottom. But if I think like that, then I am a foolish person. In reality, it does not happen like this. In reality, it may happen only as a matter of luck, or maybe as a matter of accident. Sometime it may happen accidentally. But if you think you can analyze and find out these points, that may not be possible. All right. So what a wise trader or a professional analyst will normally do is, he will sell off here before reaching the peak. His analysis will tell him that the peak is about to come, better get out now. So he will exit, or he will sell out even before the peak has come. And when he has to buy, he will not buy here, he will not look for the bottom. He will look for a confirmation. Once it has come here, the first retracement level, if it starts moving up, then he will buy here. Got it? And despite that, you will have to keep some stop loss. First of all, as I have said, you will have to wait and see for a confirmation that the retracement has ended and the direction here it has started going up. And despite that, as I said, you must keep a stop loss or a counter trade position to manage your risk. What happens, say, even if you have waited, you have seen for a confirmation, you have taken a buy trade here. What happens if suddenly something happens and the price again starts coming down like this? What happens? You will be in a loss. So therefore, you have to manage your risk by a counter trade or a stop loss. And all this risk management will cost you something. It will reduce your profit. Say if you have taken a stop loss and the stop loss hits, you will incur a small loss. If you have taken a counter trade, that will not come free of cost. You will have to incur expenditure. So that will reduce your profit. Better to reduce your profit and manage your risk rather than being foolish and being naked at times. Alright? Therefore, I always say that a professional trader can expect to make a decent living, but don't expect to make a killing. By being a small time trader, you cannot become a millionaire in a fortnight. Don't think like that. But yes, your hard work, your knowledge, your patience, your intelligence, all that will give you results, and over a period of time, you will definitely accumulate more than what you require. Got the point? Now, probably in the next lesson, I will explain to you a live example with a live chart as to how you take a position based on Fibonacci retracement during an intraday trade. All right.